Good evening. This is the post-market recap by AGI-ERA. Today is Monday, February 9th, 2026, and it is shortly after 4:30 p.m. Eastern Time. The scoreboard and technicals. The U.S. session has officially wrapped, and the price action suggests a nuanced battle, with bulls showing some resilience despite underlying concerns. The S&P 500 finished the day up 0.47%, settling at 16,964.82. Technically, the index is now trading holding above the psychological 6,900 level, a sign of underlying strength, but its ability to push significantly higher was capped. The Nasdaq 100 moved higher, closing 0.77% higher at 25,268.114, indicating continued appetite for growth-oriented technology names. The Dow Jones Industrial Average finished up by 20 points, closing at 5,135.87, showing a more modest advance. Crucially, trading volume today was lighter than average for the S&P 500, with approximately 2.36 billion shares traded. This implies that today's upward move, while positive, may lack strong long-term conviction from institutional players, suggesting caution rather than a decisive shift in sentiment. Market breadth and sentiment. Under the surface, the fear gauge, or VIX, data for which was not available today, typically provides insight into market anxiety. However, the divergence in sector performance offers a clear picture of investor positioning. Money flowed noticeably into technology XLK, which gained 1.54%, while utilities XLU lagged significantly, posting a modest gain of 0.30%. The spread between technology and utilities today tells us that investors are favoring growth and risk-on assets despite the overall lighter volume, suggesting a selective pursuit of returns in high-growth areas. The macro engine room. The primary driver of today's moves can be traced back to the broader macro landscape, particularly currency markets. The 10-year Treasury yield data, for which was not available today, often dictates the flow of capital, but its direct influence on today's equity movements was less clear without specific data. Meanwhile, the U.S. dollar index is down, settling at 96.75. This move is significant because a weaker dollar can make U.S. exports more competitive and potentially support multinational corporate earnings. Today's decline appears to be a response to broader currency market dynamics, with the dollar falling ahead of key data releases, as indicated by market narratives. And crude oil is trading around $64.42, up on the day, responding to ongoing supply-demand dynamics and geopolitical factors that continue to influence energy prices. The AI and Tech Monitor. Turning to the leaders of this market, artificial intelligence and big tech. Nvidia finished the day up 2.3% at 194, continuing its strong performance. Microsoft closed up 3.13%, while Apple finished down 1.32%. Other notable movers among the Magnificent Seven included Meta, which was up 2.38%, and Tesla, which gained 1.47%. The weakness in Apple is notable because, despite strong recent iPhone sales, investors are expressing concerns about its lagging AI strategy compared to rivals, potential margin pressure from rising component costs, and slowing iPhone growth in the crucial China market. This highlights a critical divergence within big tech, where AI leadership is increasingly paramount, and companies perceived as falling behind in this race are facing investor scrutiny. After hours and look ahead. Looking at the after hours tape right now, shares of Gray Media Inc. GTN.A are moving significantly, up over 56% on what appears to be company-specific news. As we pivot to tomorrow, the economic calendar for specific catalysts was not available. Investors should specifically watch key technical levels on the major indices, particularly the S&P 500's ability to hold above 6,900 and any further developments in the AI narrative that continues to shape the technology sector. That is your comprehensive closing update. We will see you tomorrow morning for the overnight brief. Disclaimer: this podcast is not financial advice. Data may be delayed or inaccurate. Always conduct your own due diligence.